Last week, I ran United Airlines, yeah, UAL, through 5 distinct valuation models and 2 legendary investing checklists. And honestly, what I found completely shocked me. Welcome to The Explainer. Today, we're popping the hood on UAL for a high-stakes, fundamental breakdown using real data and deep financial modeling to see exactly what Wall Street is quietly betting on. Seriously, stop what you're doing. If you own airline stocks right now, or even if you've been actively avoiding them like the plague, you need to hear this. Look, 97% of analyst ratings go absolutely nowhere. It's mostly just noise. But right now, institutional money is aggressively obsessing over this one specific airline. And the underlying data we found, it is wildly contrarian to the current market narrative. Just look at this number, 73.1%. Based on top analyst models, this stock's intrinsic value could be up to 73.1% higher than its current trading price of around $105. That points to a massive, highly optimistic price target of $182 a share. In a market where true value is ridiculously hard to find, a margin of safety this wide is almost unheard of. But that brings us to a really bold, honestly kind of uncomfortable question. How in the world can an airline literally double its fuel costs, agree to pay its pilots up to 40% more over the next few years, and somehow still confidently target double-digit profit margins? There is this massive tension right now between United's incredibly bullish financial metrics and the terrifying macroeconomic realities they're flying directly into. Look, it's no secret. We all know airlines are notorious wealth destroyers for retail investors. It's a highly cyclical, cash-burning industry. Even Warren Buffett famously dumped his entire portfolio of airline stocks during crisis mode. And Peter Lynch? He always warned us about falling for these cyclical value traps. So it's a very valid fear. But, sometimes the market overcorrects. So by the end of this explainer, you'll know exactly if UAL is a massive Buffett-style value buy or just another classic Lynch value trap. I'm going to give you a clear, actionable framework to understand these fundamental metrics and macroeconomic headwinds. You can literally steal this framework to make your own informed decisions. Let's dive right in. Let's kick off the fundamental breakdown by looking at the broader market sentiment. The current Wall Street consensus is incredibly bullish, which honestly is really rare for an airline facing this level of economic turbulence. Out of 26 top analyst ratings tracking United, we're looking at 24 buys, 2 holds, and exactly 0 sells. Think about that. Not a single top-tier analyst is telling you to sell this stock right now. When institutional sentiment aligns this aggressively without a single detractor, it really signals that the underlying fundamentals might just be strong enough to weather the coming storms. Now, the core valuation metrics are where the story gets really juicy. UAL boasts a massive market cap of over $34 billion, but the PE ratio is sitting at just 9.9x. Even crazier is the PEG ratio at 0.1x. Quick refresher, if you aren't familiar with a PEG ratio, it stands for price to earnings to growth. It basically measures a company's valuation against its expected earnings growth. Typically, anything under a 1.0 is considered undervalued. So a 0.1x PEG, that indicates extreme underlying value. The market is basically pricing this thing like a dying legacy business, but that valuation is heavily backed by their record first quarter revenue of $14.6 billion. So why are those financial numbers so strong? It all comes down to CEO Scott Kirby's execution. They are actively decommoditizing the brand. Think of it like trying to turn a basic everyday utility into a premium, gotta-have-it experience. For decades, airlines just raced to the bottom, right? Stripping away perks to compete purely on cheap fares. But United is completely flipping that script. They're focusing intensely on winning highly profitable, brand-loyal customers across all cabins. It's no longer just about getting from point A to point B. It's about elevating the whole travel experience so you actually choose United, even if it costs a few extra bucks. And this strategy translates directly into tangible revenue catalysts. They're rolling out massive upgrades to lock in that customer loyalty. We're talking about innovations like the new Relax Row, which literally turns economy seats into comfortable couches for long-haul flights. Pretty cool, right? Plus, they are deploying a huge new fleet of A321neo coastliners packed to the brim with premium seating. And here's a huge one for business travelers. They are rolling out fleet-wide free Starlink high-speed internet for Mileage Plus members by 2027. These aren't just flashy little perks. They are calculated, major investments designed to drive recurring premium revenue. But, of course, the true test of a premium product is how it holds up under intense pressure. On one hand, United hit an incredible 14% growth in premium cabin revenue. That proves their strategy is actually resonating with flyers. But they are simultaneously battling the brutal reality of a $340 million increase in jet fuel expenses compared to the exact same time last year. That surge is largely driven by geopolitical conflicts in the Middle East, stuff completely outside of United's control. It creates this really high-stakes tug-of-war between soaring premium revenue and crippling fuel inflation. And unfortunately, fuel isn't the only massive headwind threatening those profit margins. Labor costs are just surging across the entire industry. United's new labor contract with the pilots union locked in an immediate 14 to 18% raise starting back in 2023. And those raises keep stepping up year after year, 5% in 2024, 4% in 2025 and 2026, and another 3% in 2027. Add it all up, and we are looking at an up to 40% cumulative pay hike over the 4-year lifespan of the contract. When you actually run the math on those compounding raises, it totals roughly $10 billion in estimated additional costs going directly into the pockets of pilots. $10 billion. That is a massive structural increase in their long-term operating expenses. And naturally, it raises some really serious questions about the sustainability of the airline's broader network. Because when your baseline operating costs skyrocket by $10 billion, flying those thinner, less profitable regional routes, that suddenly becomes a huge financial liability. So, how exactly is management tackling these dual threats of fuel and labor? Well, CEO Scott Kirby put it pretty bluntly on a recent earnings call. He said it simply doesn't make sense to fly marginal flights that will lose cash in a higher fuel price environment. They are fundamentally shifting their entire business model. Instead of just fighting for market share at any cost, they're prioritizing profit margins over pure capacity growth. Essentially, if a flight doesn't make clear financial sense in this high-cost environment, United is simply not going to fly it. Here is the exact actionable framework United is executing right now to survive these compounding costs while keeping their premium engine running. Step 1, they cut planned capacity growth by 5 points for the rest of the year, basically trimming the fat off their network. Step 2, they successfully implemented broad ticket price increases to pass those rising fuel and labor costs directly onto consumer yields. And step 3, the ultimate goal is to recover 100% of these fuel costs to hit double-digit pre-tax margins by 2027. It's a highly defensive strategy, but played with a lot of offensive confidence. Now, despite these massive cost increases and those defensive network cuts, their financial resilience is actually improving at a really surprising rate. In the first quarter alone, United managed to pay down $3.1 billion in debt. On top of that, they successfully raised $2 billion in unsecured bonds. They are pushing super aggressively toward their ultimate long-term financial goal of reaching an investment-grade credit rating. For a capital-intensive business like an airline, achieving that investment-grade rating is a huge deal. It drastically lowers the cost of borrowing, which creates a really powerful compounding effect on their bottom line over time. So when we weigh the sheer power of their premium engine against these heavy macroeconomic headwinds, the risk-to-reward ratio becomes pretty clear. With the current trading price sitting right around $105, the absolute lowest analyst target out there is $95. That means the modeled downside risk is currently less than 10%. Meanwhile, the median target sits at a very healthy $130, representing solid upside. And those highly optimistic bulls, they are holding firm at that massive $182 target. They are betting big that United's premium transformation will vastly outpace its operational costs. Which leaves us with one final, provocative question to ponder today. Will United's premium engine, strategic capacity cuts, and intense focus on brand loyalty actually outrun the massive macroeconomic gravity of soaring fuel and labor costs? Or is that $182 price target flying just a little too close to the sun? Take these valuation metrics, run them through your own checklists and models, and decide for yourself whether this is the value play of the decade or just a trap waiting to spring. Keep learning, stay disciplined, and I'll see you in the next explainer.